So I want to talk about, the next one is, now that we've talked about unorthodox monetary policy. I want to talk about monetary and fiscal policy failures and policy ineffectiveness. Now there's a theory that is called the quantity theory of money. Now here's the next thing we're going to talk about. Is the Federal Reserve is targeting a 3 to 4% GDP growth rate, okay? But we're only getting 2%. And actually we're getting less. And actually if you listen to the budget presentation this morning by the president, under their budget scenario, they're forecasting 3 to 4% GDP growth rate for their budget to work, okay? 3 to 4%. And Larry Summers, who's an economist, he was an economist with the Clinton administration and with some of the Republican administrations too. He basically said the budget was dead on arrival because their assumptions were wrong. The economy has basically been growing based on gross domestic product at between 1 and 2% for the last 9 to 10 years. And most economists would think that the ability to grow the economy faster than 2% is totally unrealistic, so their budget is completely unrealistic. Because they're using 3 to 4%, and we've been running at about 1 to 2. So that's on the fiscal policy side, that's a problem. But here's the other thing that I think is really interesting, is the Federal Reserve has been trying to target a 3 to 4% GDP growth rate, and was growing the money supply at 30 to 40% in 08, 09, 10, 11, 10% in 11, 12, 13, 14. That should have been enough to stimulate the economy to get to GDP to grow to its target, but it didn't. So the question is why? Okay. So I racked my brain on it, and another economist, one of my professors, I remember him teaching me what was called the quantity theory of money. So it's basically a macroeconomic theory called the quantity theory of money. So I thought about the quantity theory of money. Quantity theory of money. What is the quantity theory of money? And the quantity theory of money was invented by Irving Fisher. Again, brilliant economist, came up with another theoretical construct to basically describe how the world works. And basically Fisher stated that the quantity theory of money was basically real GDP, or nominal GDP growth rate. So nominal GDP. Growth rate times the inflation rate equals the velocity of money times the money supply growth rate. Got it. So there's the equation. So I racked my brain on that one too. So the inflation rate we know is they're trying to target a 2%. We know that. And we know that they're trying to target GDP growth rates of around 4%. We also know that they've been growing the money supply at 30%. But why hasn't GDP grown? You have inflation set, you have money supply that's being growing at a very fast rate, but still you're not getting the 4%. So it's got to be in the velocity of money. The solution has got to be here in the velocity of money. And money, there's different types of money. Monetary stock, It's either it's called the stock of money or money aggregates or monetary aggregates. And the velocity of money, there's two types of money. There's M1 and M2. And basically, M1 is cash and near cash. M2 is a broader definition of cash. So, but it could be like mutual fund, money market. Money market mutual funds and other types of liquid but somewhat illiquid assets. And M1 is what I used. And basically the velocity of money states what is the number of times cash in circulation in the economy turns over. How many times does the cash in the economy basically circulate, turn over? So I was saying, okay, inflation's held in check, money supply's growing, we're not getting GDP, it's got to be in the velocity of money. It's got to be the solution. So what is, first was what is the velocity of money? Well, we now know what the velocity of money is. It's the number of times. So obviously if you're growing the money supply, and if inflation's being in check, and if the velocity of money goes up, GDP growth rate's going to go up. So the solution is in the velocity of money. So the question then becomes, why? Where is the velocity of money? So I went back and I looked, and this is actually M2. And I'm going to say, as you can see, basically the velocity of money is pro-cyclical. It moves with the business cycle. And then the velocity of money increased significantly in the late 1990s, along with the boom in the stock market, technology, and all those factors that were really driving asset price volumes. And then the velocity of money collapsed, and it actually goes down during the recession. Went up again in 06, 07, and then basically has totally collapsed. Collapsed and broken through its long-term, multi-decade support. Yes, sir.
What exactly is this tracking?
This is tracking the number of times money circulates in the economy.
How would I know that?
Because this is from the Federal Reserve. The Federal Reserve basically controls cash, gets all of the cash information from the banking system.
Okay.
So it's all tracked, okay? So, but the fact is, the thing that's really interesting is you can't pump a ton of money into the economy to basically get it to grow, right? Because one way of growing the economy, if the velocity, if we holding these two constant, if the velocity of money goes up, GDP goes up. Holding velocity and inflation constant, if you grow the money supply, GDP goes up. Okay. So the question is, well, inflation's a constant, they're growing the money supply like mad. They're not getting GDP growth rate targets, so that the problem's got to be the velocity of money. So you go back and you look at the velocity of money, and it's totally collapsed. People aren't investing, people aren't saving, people are taking money out of the system and putting it under the mattress for precautionary purposes. And basically, John Maynard Keynes basically said that at some point in time in history, the distress associated with financial crises and depressions and recessions, people are going to be so scared that they're going to take their money and they're going to put it under a mattress for precautionary purposes. They're going to sit on huge loads of cash. And the cash isn't going to be in the system. It's not going to circulate through the system, and it's not going to create economic activity. So it's in the velocity of money. That's the problem. And I've only heard probably a half a dozen, if that, economists even talk about the collapse in the velocity of money. Now the question then becomes why, right? Why has there been a collapse in the velocity of money? And I think I figured it out. I went and did the research, and I kind of figured it out. First is shadow banking. We now have basically unregulated banks that basically take deposits, or not even deposits, just investment money, loanable funds, out of the system and are not even tracked. And they can go anywhere. There's no regulation. These are shadow banking systems outside the banking institutions that are regulated by the Federal Reserve and the comptroller of the currency.
Do you have an example of one?
Hedge funds. Hedge funds would be a good example. Unregulated financial institutions that basically take money from savers and then invest it. So we can't even track it. So a lot of the velocity may be just, we can't even track it. Because now the money's inside a private banking industry that's untrackable. Okay, that's one. The other is low labor productivity and participation rates. The velocity of money is pro-cyclical and highly correlated, to employment rates, to employment. I have more money, I'm employed, I make more money, what do? I save it in the bank, I invest, I consume, creates multiplier effects, creates velocity as I spend and consume more and save more. So one is very low productivity rates. Currently, labor productivity is negative, it's a big issue. The other is labor participation rates are extremely low, okay? Extremely low. In a time period where women are fully participating in the labor force, okay? In the 1970s and late 60s, labor participation rates were at 78%. With mainly male-dominated workers participating in the workforce, there was no women participating in the workforce at that point in time. But by 2017, the labor participation rate has collapsed to 65%, with full participation of women in the labor force. So a total collapse. This is a labor market failure. When you do not have full labor participation of people who are willing and able to work, okay? And if you look at the labor participation rates, they've totally collapsed. So there's a lot of people who are outside the labor force that aren't working, aren't generating income, aren't saving, aren't consuming, aren't investing, so the velocity of money collapses because of extremely low participation rates.
But if unemployment is 4.4,
There's because the participation rate basically reflects the people who are able to work and participate in the labor force. The unemployment rate is an artificial number. It basically looks at people who have claimed, who are claiming unemployment benefits. Divided by the labor force.
So less people are claiming unemployment, so
You
it
got
looks
it.
like there's more people working?
That's right. So as people roll off the unemployment rolls because they can't find work, because they're too old or other types of discrimination or other types of labor market factors that constrain their ability to get jobs and participate in the labor force, when they first get laid off, they claim their unemployment benefits. So that pushes up the claims, which makes the unemployment rate go up. But at some point in time, your unemployment benefits are only limited to a certain period of time. Once you can't find a job, you are now off the unemployment rolls, which pushes down the number of people claiming the benefits. Holding the labor force constant pushes down the unemployment rate artificially. And basically the Federal Reserve is going, wow, our unemployment rate is 4.4% and we're not seeing inflation. So there's something wrong. Right? So labor productivity and labor participation rates have a direct correlation with the velocity of money. And there's a huge labor pool of millions of men, African American, Hispanics, that are currently incarcerated, permanently outside the labor force. People, particularly males over the age of 50 years old, outside the labor force, they can't get jobs. So there's huge pools of human capital that aren't participating in the labor force. They're outside the labor force. So this is a big problem which has a direct relationship to the velocity of money. So if you want to cure the velocity of money and increase the velocity of money, you invest heavily in education and training programs and try to lift the participation rate, which will lift the velocity of money. I've only heard maybe 2 economists talk talk about this. Capital labor substitution. When the Federal Reserve drove interest rates to really low numbers, low levels, it basically allowed corporations to say, hey, you know what? When things start turning around, why should I hire people back when I can basically borrow from the bank at really low cost of capital and basically invest in labor substitute machinery? Why would I hire 6,000 people when I can buy 600 machines and not have to deal with the unions or healthcare or any of that stuff? I just go to full automation. So labor capital substitution rates have a major effect because it impacts participation and employment, savings and investment and consumption. Also, Fed over-accommodation. The Fed has over-accommodated the economy, printed money, bought bonds, drove interest rates to zero. Why would I do anything with my money? Why would I invest in bonds or in CDs or, you know, put my money on deposit at the bank when I'm getting zero or negative interest? Just hold it in cash is precautionary. So basically, the Federal Reserve, in lowering interest rates to zero, actually has collapsed the velocity of money in the process too, by disincentivizing people to save and consume and invest. Oh, falling savings rates. Falling savings rates are at historical lows. We used to save 10% of our income. Now it's at like 2 or 3%. So this consumption economy and basically the inability of people to generate wages, real wage growth, basically has caused the savings rate to basically decline and collapse. And people use credit cards and other types of loans to basically be able to maintain their standards of living. Well, if you have high debt loads, both corporate debt loads, government debt loads, and personal debt loads, the majority of my income is going to servicing the debt. It's not going into savings, consumption, and investment. So it collapses the velocity of money also. And then, like I said earlier, rising precautionary cash balances. When you're taking cash out of the system, it's not in the system, it's not circulating, there's no velocity. Okay. So those are basically that's basically the theory and the application around monetary and fiscal policy failures and policy ineffectiveness using the quantity theory of money, focused on the velocity of money. Yes, sir.
Would you mind explaining how the global jobs outsourcing?
Oh, yeah, I forgot about that. Sure, I mean, labor participation rates are really low because 10% to 20% of a lot of corporations will basically outsource to India and China and Latin America and Russia and other places across the globe because the labor costs are extremely cheap. So instead of hiring people here, which increases participation and employment rates, that increases more income and velocity of money, when you basically outsource, you're outsourcing and the money goes out of the system, it leaks out of the system, and you don't get the benefit of the velocity of the money through outsourcing.
So that's what is President Trump want to revise.
He wants to do that through regulation, but I'm not sure you can put the genie back in the bottle,
Yeah.
right? I think education and probably healthcare and job training to increase labor participation rates and get the 50-year-old males and maybe work on immigration and maybe incarceration to basically get people to participate and work in the economy, to pull up the participation in employment, pull up wages, savings, investment, consumption, velocity, GDP. And I haven't done the calculations on the total loss of the amount of GDP loss. I mean, just imagine if the labor participation rate, you know, was at full, this integral right here is the total lost income revenue, income wages that we've lost over the years due to low labor participation rates. But there's no policy, right? It's not sexy to talk about labor policy. It's easier to talk about tax cuts and banking regulations and deregulations than to talk about really labor policy. It's basically the way our system works. I mean, we're capitalistic, we're not socialistic. We focus on capital, trickle-down economics, supply side. We're not Keynesian demand side society. We don't focus on labor here. It's just the way it is.
By putting more money in the system, they're expecting something to happen, but if we're not training people, educating people, getting them jobs, how's that? It's like working against us.
Yeah, well, what happens is it stratifies the socio-demographics. So you have basically highly skilled, high-tech, highly educated workers, and then you have everybody else. And then other segments of the economy. So it starts to bifurcate, and then you start to concentrations of wealth by certain socio-demographic groups. It's not broad-based distribution and benefits, it becomes very segmented. Okay, and that's what's happened over the last 9 to 10 years. Okay. All right. Any questions on that? I guess I'm putting in my own personal opinions here where I should probably shut up, right? So that's that one. What I want to do is maybe we should kind of stick on that theme, you know, social and economic engineering, and talk about, go back up to the institutional level to look at dynamics at the institutional level. Because again, the book talks about it, but again, really doesn't talk about it, kind of avoids it. And Mancu's famous for this, to avoid, and just, I think most of the books just try to avoid a lot of the issues. So what I want to do is I want to go back. I'm sorry about this. I should probably not try to torture you as much. So what I'm going to do is I'm going to go back.
Are
And
those
get-
the slides that are online?
Yeah. So I'll be talking right now from slides 5 through 10. Okay, you might want to make a note of that. Okay. And I'm just going to take you through like the mini presentation here. This will not be, I'll tell you what's going to be on the midterm right now. But my analysis, efficient real estate, security, capital markets require strong public and private sector cooperation. So we talk about that a lot in economics, the cooperation between government, particularly government and business, okay, and business-government relations. So you need that cooperation. You need disclosure of government and corporate financial conditions. You need transparency in both fiscal and monetary policy, but also transparency in corporate financial statements to really understand the value in which you're purchasing when you buy that security. And you need institutional and individual investor confidence in both the financial and the political institutions. If you don't have this, you're going to have a misappropriation of resources. You're going to have underallocation, underproduction, underemployment, low and falling real wages, and low and falling standards of living. And you can see it, you can use this as a hypothesis to test countries across the world, and you can see the countries that have violated this hypothesis and see their standards of living either be extremely low or collapse. I mean, Venezuela is probably a perfect example, and probably Syria also example. So this is kind of the institutional frame. I think I talked about this a little bit before, which was really the approach, my approach to valuation. And it's really the economic approach and your business education approach too. We are in the social sciences. We're not in the natural sciences, so it's a little messier when we do analysis. There's more factors, there's more variables, the data's not as clean, we have a lot of errors, so it's really easy to make mistakes in your decision making. And this model is basically, models your business education perfectly. Because my thesis is, if you're trying to value a stock or a bond or a company or a piece of real estate or a security, you're trying to value the equity. When you're conducting the analysis, you need to understand the managerial and the financial accounting. You got to understand the financial statements. You got to understand how they roll up into basically financial ratios and statements to be presented to the bank, or to take your company public to the public markets to get the money that you need to finance your assets, to be able to grow your firm, and to know when to access that capital and try to access it at the cheapest amount of capital within the capital markets in which you basically are borrowing from. And you have to understand the economics, the fiscal and the monetary policy. We're getting fiscal policy, tax policy is being rewritten right now. We're trying to rewrite it. The monetary policy authorities are basically managing the economy. by rising and lower bond prices and interest rates to stimulate and to cool the economy. So you have to understand both fiscal policy and monetary policy. You have to understand politics, because politics, either your grievances or initiation of policy from the legislative branch or the executive branch, is going to bring policy that then is going to be debated and reconciled through the lower house to the Senate, back to the House, back to the Senate, then to the president for signature. Once it becomes law, it moves through the public administration, the public administrative bureaucracy. And those policies have intended and unintended outcomes for different socio-demographic groups, different geographic locations across the United States. So you have to understand that how policy is formulated, how it becomes law, and then how it's administered, and how it has economic and financial impacts on individuals, countries, and firms. And then our legal and political system, and even our administrative system, is modeled after Western European systems. It's based on Western philosophers and philosophy. Jean-Jacques Rousseau, John Stuart Mills, Adam Smith, the founding fathers, basically all put in place basically the political and economic frameworks that basically govern our society and basically show you how the world works. And if you want to know how our world works, just go back and look at theocracies that were developed thousands of years ago. It's basically the same institutional structures that were put in thousands of years ago currently exist in our society today. So the question is, do you understand the variables that are in these models? Do you understand that there's variables in one model that are also in the other models? And any changes in the variables will have a direct or indirect impact on the value of your equity, the value of the equity in the bank, the value of the equity in your bank account, in your stock portfolio. So you have to be able to solve these institutions, these equations simultaneously to get the outcome. And the way that, because we're lucky, because we study here, right, in a peaceful environment and a very high quality of life, we have linguistics, we all speak English, and we all have psychology, we all basically dress the same, we have the same cultural norms, we have the same sociology, we're now enabled through telecommunication and technology, we have supercomputers in our hands now to be able to access information and to communicate in real time. We're the most powerful generation ever, because not only can we solve this and do this, but we have enabling technology, cognition, and linguistics to be able to make it happen. So the model, I think actually is correct. So the first two models, the dialectic, and this is a political economic model. And it's not a cycle model, it's a political economic model. Okay, that basically, in my view, again, is another model that explains how the world works. The book does a pretty good job, but again, you got to start moving into political philosophy and economy to really get some of the answers, because this is how the elites think. This is how they analyze. When they're formulating policy and running governments and running economies, this is how they think. Okay. So the model basically states, and again, he was a late 1800s philosopher economist, that basically noticed that over time, civilizations go through dialectical shifts that basically established orthodoxy, established institutions of governance and economics are basically put in place. And then at some point in time, they run their course. They eventually become illegitimate or corrupt, and eventually you have revolutions and wars that basically destroy the institutions that then need to be recreated and reconstructed into a new governing structure. So the original governing structures, the economic political structures, is the thesis. And if you go back in time, prior to the Great Wars, it was aristocracies, authoritarian dictatorships, and fascism. Those basically, we went through brutal wars to basically throw off those institutional constraints. And what emerged was an antithesis and a new synthesis that was made up of democratic capitalism, Keynesianism under Franklin Delano Roosevelt, centrist political ideology, and regulated markets. And that basically ran from 1945 to 1975 until basically a new type of political and economic institutional structure came in, and there was a new neo-Keynesian Cold War capitalism and globalization, open economies, from closed economies to open economies. So that transition from basically post-World War II to modern 70s, 80s political institutional structures lasted 30 years. And then from that antithesis became a new synthesis and a new thesis that basically this neo-Keynesian model, this Cold War capitalism globalization, lasted from 1975 to 2007 and then utterly collapsed under the financial crisis. And the financial crisis was so severe that we are now witnessing institutional rearrangements, new economic paradigms and political paradigms on a global basis, new negotiations between governments, governments and their citizens, government and corporations, corporations and consumers, consumers and voters. It's changing dynamically now. So the question then becomes, if that neoliberal economics and monetarism, neoclassical thought, that basically was the thesis, and we went through the financial crisis, what is the next 30 years going to look like? What is the new political, economic governing structures that will dictate how the world basically operates? And from what I can tell, which we don't know, I mean, populism is pretty popular these days, and renegotiation of global trade treaties, but I think it might be some kind of new type of Keynesianism, some maybe re-regulation of markets, although it doesn't seem to be working under Trump. They seem to be dismantling and deregulating again. A progressive demographic or democratic policy, manage markets. This may not be the reality now, after the reality of what happened in the presidential election and the movement to the right. But what I thought was really interesting is I went back and I traced out I basically did all of this research first, and then I went back and I calculated the dialectics. So the first dialectic was 30 years. The second dialectic was 30 years. The third dialectic was 32 years. So I basically went back 90 years, and the dialectics on average last 32 years. So if that's the case, and the financial crisis set off the dialectic, then we are basically in the first 10 years, the first 15 years of the 30-year dialectic. So new institutional arrangements. So we have to be cognizant. And people tell me sometimes, it's like, well, what does this really matter? I'm going to be dead in 30 years. Well, pension funds and institutions aren't. Banking institutions are not. They have 30-year assets and 30-year liabilities. They have to be thinking in these terms to be able to manage their assets and their liabilities, because their liabilities are 30 years out. So they have to be thinking in these 30-year or 100-year dialectics to be able to manage and make sure that the financial institutions will last forever in a multi-generational standpoint. Okay, so that's really what I was trying to get at there with that. I know it's pretty heavy stuff, but I think it's the truth. The next solution that I came up with, and I used the economics and the political science models, but I had to go to the philosophical models I think to get my real answer. The next one is public choice and mean voter theorem. So this is the political economics. The other one was the political philosophical. This is political economics. And this is basically microeconomic applications of voter preferences. And again, the book talks about public choice. It doesn't even talk about the theory and doesn't even really dissect the theory into application. So basically what I did is 9 years ago, trying to figure out the consequences of the financial crisis and the origins, was I had to go back and look at the mean voter theorem. And the mean voter theorem basically states, and you hear this rhetoric when you're listening to CNN and Fox News and other types of networks. You know, a lot of the pundits would use this type of analysis. We'll talk about centrist policy and, you know, right wing and left of center and right of center and extreme right and extreme left, to be able to articulate political economic philosophy, really ideology, which is how the world basically is governed. And if you go back, and I retraced out using presidential presidents as demarcation, political shifts in ideology over time tied to economic ideology too in policy. As you can look after World War II, you had Roosevelt and Truman, very Keynesian economic policy to basically push the economy forward. And then you had Eisenhower, probably the greatest president ever. Johnson, Kennedy, Nixon, you started to see this rightward shift, and you actually started to see a pretty major rightward shift in political economic ideology under Carter. And then you had Reagan, that basically came in the early 80s, and his political ideology and economic ideology was enabled through a technology called cable TV. So the ability to mass the masses and get them to go to the voting booth, to basically then control federal, state, and local elections and policies by mobilizing voters through cable TV. So major advancement in technology had a major effect on political and economic ideology. Then you saw Bush 1. You had Clinton that came in. He pushed his party even further to the right and refashioned the Democratic Party from basically being centrist and left of center to right of center as progressive Democrats, taking over for the moderate Republicans in the process. You had Bush 2, enabled by Fox News and other large networks that basically pushed political and economic ideology and basically pushed it even further to the right. You had Obama that basically won against Palin and McCain and basically brought back the spectrum back to the right of center. But then you had the emergence of the Koch brothers and others outside the systems having direct policy input both politically and economically. And then you have the emergence of the Tea Party that basically pulled the spectrum even further to the right. And then you had Trump that even pulled it even further to the right. And then won the elections, understanding and knowing the power of TV and mass communications to then be able to sew up basically the nomination, but also be able to move the party and the politics towards the left of center and then capture the election through populism. And you can really see the data when you look at the map. So these were basically the states that were won and the judiciary and the municipalities that voted for Trump. And here you have basically the wealthy coastal markets that were mainly Democratic. So a major appeal to a certain demographic that then was able to then be mobilized to the voting booth. Now the Republican Party are monetarists. They believe in supply-side trickle-down economics, tax cuts. The Democrats believe in more social goods, public goods, education, healthcare, infrastructure spending. So it's a political economic ideology that's basically battled out, not only for the presidency, but also for control of the House and the Senate. That then eventually, depending on who is elected, then gets to appoint and pick the judiciary. And then the judiciary has basically the decision on Supreme Court, basically decisions. When a lot of the policies have negative outcomes, those negative externalities are then brought as class action lawsuits and grievances by certain groups of individuals that then move through the court system and eventually to the Supreme Court and the appeals court. And the Supreme Court is basically the last arbitrator on political philosophy and economic outcomes associated with those legal decisions. So that's basically public choice and mean voter. Any questions on this? I know I went through it pretty quickly. No? Okay. The only reason why I can see this stuff was by spending the time, getting the master's degrees in econ and political science, public administration, those things, and then studying a lot of the theory and then updating them to make them relevant. And I think it goes in augmentation with the book, but the book just doesn't get into enough analysis or detail, in my view, to really make it relevant. Let's go back to something less heavy, and let's talk about, go back to the yield curve. Let's go back to the yield curve and answer C2, discount rate and expected returns and cost of capital, because we already talked about yield curves and how the yield curve is the risk-free rate, and then we're almost done. So if you go back to the yield curve, again, it's interest rates, risk-free rates, by maturity along the curve. This is the risk-free rate. It's the base rate. So if I want to come up with an expected return on a bond that I want to buy, or I want to come up with an expected return on stock that I want to buy, I have to start with the risk-free rate. And we know that the risk-free rate is the real rate plus inflation expectations. And if I want to determine my cost of debt, I want to issue some bonds, I got to figure out what the cost is going to be, what the cost of capital is going to be. And if I'm an investor, in that bond, I want to figure out what my expected return is going to be on that bond. Because again, if it's going to return me less than what I expect, I'm not going to buy it, because there's too much risk involved. So when you're trying to determine the cost of debt, the cost of the bonds, the cost of capital for the bonds, or the expected return on the bonds, we would use what is called the risk premium approach, or risk premium approach, to determining the discount rate for the cost of the debt, or the expected return on the debt. And the first variable in the cost of the debt is going to be the risk-free rate. Then the theory basically states that you have to start tacking on what are called risk premiums. You need to be compensated for the risk that you're taking in investing in that bond, particularly corporate bonds. Because corporate bonds have a risk premium, what are called default risk premiums, credit default risk premiums. So I'm a corporation, I'm IBM, I want to issue some bonds. Well, I'm not the federal government, right? I can't borrow at the risk-free rate, that's credit default. I don't have a Federal Reserve to print money to basically service the bonds. So basically the market, the investors, are going to tack on a default risk premium because you're not the federal government. So they want to be compensated for the probability and the risk that you could default on the bonds and maybe even go bankrupt at some point in time in the future. So you have to add on a credit default risk premium. And usually the credit default risk premiums are determined by credit ratings. And that could be Standard & Poor's or Moody's or Fitch. And S&P has AAA, AA, A, B, 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 and junk. So institutional, the highest credit quality are going to be A-rated bonds. They have the priority of the cash flows that come through the corporation. Very low probability of default. Therefore, their interest rates, their yield are going to be really low. But these other bonds don't have priority claims on the cash flows. So if we go into a recession, these guys are getting the money, you guys aren't getting anything. So those bonds will default, and their prices won't collapse because you're not paying back the investors. So the lower the rating, the higher the cost of capital. The higher the rating, the lower the cost of capital, the lower the rate of return. The next premium that you have to add on is illiquidity. It's an illiquidity risk premium. Now, corporate sovereign bonds, government bonds, are highly liquid. It's a huge market. The corporate bonds trade thinly, so they don't have the liquidity and the marketability that the government bonds have. So the investors say, I want to be compensated for illiquidity risk that I'm taking in buying that bond. So I want to be compensated. The next is maturity. Is the maturity. It's maturity risk premiums. The longer the maturity of the bond, the more sensitive it is to not only changes in interest rates, but also the probability that the bonds could be defaulted on in the future. So the longer the bond, the higher the probability something could happen. So the investor says, I will buy a long maturity bond, but I want to be compensated for the maturity risk. I want to be compensated for the time period in which I'm going to hold this bond. And the longer the bond, the more sensitive it is to movements in interest rates. So a short-term bond, if interest rates go up and down, the price moves a little. But a long bond, if interest rates go up and down, its price has huge swings to it. Okay, so it's more sensitive to movements in interest rates. Other risk premiums that you could tack on there, if it's a global bond, a euro bond, you have currency risk. If it's a municipal bond and there's changes in the tax code, you have tax risk premiums. And I'm telling my students and my clients that you need to tack on political and policy risk premiums now too, because it's just the gridlock that's going on in Washington and the policies that could be coming down in the future that could have a negative impact on your business and on your bonds. So now you need to take into consideration policy and political risk premiums. Okay. And that just increases the cost of capital and increases the returns that investors want to be compensated for that additional risk. So that's the debt approach. Now we need to be able to figure out the cost of equity, okay? The cost of capital for equity. And the cost of capital for equity uses the model that is called the capital asset pricing model. And the capital asset pricing model basically states that the cost of the equity equals the risk-free rate plus the beta coefficient, we'll explain that in a second, times the expected return on the market, the S&P 500, minus the risk-free rate. This right here, the expected return on the stock market minus the risk-free rate, is called the market risk premium. And this right here, the beta times the market risk premium, is called the market pricing risk. This equation basically determines the expected return that investors have on purchasing your stock. It's going to determine the expected return on the equity for your firm. It's also going to determine the cost of equity for the firm. It depends on who you are. Am I the firm? Well, if I'm going to try to figure out the cost of my equity, I'm going to use the capital asset pricing model. If I'm an investor looking to invest in your stock, I'm going to use the capital asset pricing model to calculate the expected return on that stock, on that equity. It just depends on what side you're on, it's the same equation. Now the beta basically states really the volatility and the risk of the company. So if I'm going to look at the total return on a stock, I'm looking at the total return over time of the stock. See that the returns go like that. This is the total return on the market. This is the S&P 500. This is my benchmark. This is my benchmark index. That's the benchmark. But my stock is more volatile. It's more risky than the market. Therefore, the beta, oops. The beta is going to be a lot higher. Let's say it's 2 times the market. It basically states that the rate of return on my stock moves 2 times the market, both up and down. So it's twice as risky as the marketplace. So if that's 2, maybe somebody can do the math here. So if that's 2, and we know that the expected return on the market is 10%, and we know that the risk-free rate, I'll see if I can do the math myself. The risk-free rate is 2%. That's 8, that's 16 times 2, it's 18%. So here's an example. I'm trying to figure out the expected return on that stock. I'm trying to figure out the cost of equity for our firm. I'm going to use basically the 2% interest rate, which is basically the 10-year treasury right now. I know that the S&P 500 is return on average every single year, annually, 8 to 10% over time. And I know that our stock returns move twice as much as the market. So I can figure out what our cost of equity is, and if I'm an investor, I can figure out my expected return. So 2 plus 2 times 10 minus 2, that's 8, right? Times 2, that's 16 plus 2, that basically gives me 18%. So the capital loss pricing model is a standard in determining the expected returns by investors and cost of capital by firms. Yes.
What was the first term again? Yeah.
This is the risk-free rate. Which is basically the yield curve.
Oh, is that the same as the last term?
Yes.
Okay, got it. Same
Yeah,
yield
so
curve.
risk-free rate plus the beta times expected return on the market minus the risk-free rate. Now what I'm going to do is I'm going to take this and I'm going to go over there in a minute and I'm going to show you how this all relates to stock and bond prices and real estate prices. Because again, if the risk-free rate goes up, flattens or inverts, the risk-free rate goes up. The risk-free rate goes up, and the expected return on the cost of equity goes up. If the beta goes up, your expected return and your cost of equity goes up. If the expected return on the market goes up, your expected return on the equity and the expected cost of equity goes up too. And then vice versa, it could go down. So this equation basically determines the cost and the expected return of equity of stocks. So now let's go over here and let's finish it off. What time is it?
6:26.
What is it?
6:27.
Okay, how much time do I have? Like 3 minutes?
Goes to 640.
Okay, I can do it. And then if you have any questions or anything, you can always call me, text me, tell me, Professor Souza, I don't know what the heck you're talking about. It looks like we're not going to get to that one. So we're not going to take out the modern portfolio theory question. We don't have to answer that one. So we're not going to get to it. Okay.
We don't have to worry about it.
You don't have to worry about that. We'll do that one for the midterm. Okay. So yield curve dynamics and interest rate determination flows right into asset prices, okay, and valuing securities. There are basically 4 valuation models: perpetuity, Gordon growth, multiple approach, and discounted cash flow. Okay. The perpetuity model using the perpetuity model, this could be used for a bond or it could be used for a stock. Okay. It's basically the cash flow. T plus 1. Cash flow next year. And this cash flow could be earnings per share, it could be free cash flow, or EBIT, or EBITDA. It could be EBIT or EBITDA per share, could be net operating income, real estate. So the numerator is just basically the cash flow. And the theory is basically you take the cash flow, and you assume under the perpetuity model that the cash flows are going to remain flat forever into perpetuity. So they remain flat forever. Then you discount it by some discount rate. Could be cap M. So let's say my cash flow is going to be the equity cash flow that I'm going to receive, earnings, divided by the discount rate that I just determined using the capital asset pricing model. This is going to give me the value using the perpetuity model. So it's just the cash flow divided by the discount rate is going to give you the value under the assumption that the cash flows are going to remain flat into perpetuity. And you use next year's cash flow to do the value. Okay? The next is the Gordon growth, which basically states you take the cash flow next year. Again, if I use earnings per share or EBITDA per share, I can calculate the value of the share. If I take the earnings of the company or the free cash flows of the company, I can get the value of the company. Okay. If I take net operating income from the property, I can calculate the value of the property. If I get the NOI for the portfolio, I can calculate the value of the portfolio property. It's a simple equation for valuation. For Gordon growth is different, you modify it. And you basically take the discount rate and you subtract out the growth rate. And the growth rate, G, basically is the growth rate of the cash flow at a constant rate forever. So it decomposes to a very simplistic model, because it's linear, that basically states that the discount rate minus the growth rate divided into the cash flow is going to give you the value using the Gordon growth model, assuming that the cash flows are going to grow at a constant rate forever.
Where do you get the growth rate of cash flow from?
You can go back in time, and basically depending on how long the firm's been around, you can actually calculate the average annual compound growth rates of the earnings over time. Like IBM, you could go back, like 70 years, 50 years. It's really hard to apply this model when you're doing startup companies, because this G could be really high, right? So you're assuming very high G and you're going to get really high valuations. Perpetuity model is going to underestimate the values. Gordon growth is going to overestimate the values, right? Depending on what G you actually use. The multiple approach basically states that you take the cash flow, T plus 1, and you multiply it by some multiple. Next year's forward projected earnings per share, multiple, price earnings multiple, is going to give you the value using the multiple approach. And what's really interesting is I could use price to earnings per share. I could use the stock price divided by its earnings per share to get a multiple. I could use the value of the company divided by the earnings, or the EBIT, or the EBITDA to also get a multiple. I can also do 1 divided by I will give me a multiple, which is basically will give you the same valuation as the perpetuity model. And I can do a multiple using Gordon growth, which is 1 divided by I minus G, which will give me a multiple multiplied by the cash flow and give me the same outcome as the Gordon growth model. Why would I do it this way? This is basically academics, but industry professionals use the multiple approach. So if I know my cost of capital, I can come up with a multiple. If I know the cost of capital minus the growth rate, I can come up with a multiple. If I know what deals have gone down in the marketplace, I can also use competitive market survey to come up with multiples to apply to the cash flows to get the valuation using the multiple approach. So these are the approaches. Then the last model, which is the, how am I doing on time?
You have 6 minutes.
Got it. Present value approach basically states that I'm going to take, and this is a 3-year projection, I'm going to project the cash flows out into the future. So I'm going to go CFO T plus 1, CFO T plus 2, CFO T plus 3. So I'm going to forecast out into the future what the cash flows are going to be on the firm, on the stock, the real estate, whatever it is, it doesn't really matter. Then what I'm going to do, I'm going to create what are called discount factors. And I'll go through this a little later too. So I'm going to take my discount rate from over there, 1 plus the discount rate to the first power, 1 plus the discount rate to the second power, 1 plus the discount rate to the third power. I'm creating discount factors that I'm going to use to discount the cash flows to get the present values of those cash flows. And then what I'm going to do is I'm going to sum them all up to get the present value. But if I'm buying a company, if I'm buying a stock, I'm going to calculate a terminal value also. Because I can't project this out into infinity. And what I can do is I can come up using the perpetuity or the Gordon growth model. I can basically take the 4th year's cash flow, apply the model, get the value, add it to the last year in this holding period, and discount it back to get the present value. And if the present value is greater than the price of the company, or the cost of constructing, or greater than the price of the share, I'm going to buy it. Because the value to me is higher than the marketplace. So I'm going to buy it. I'm going to buy that investment. So if I can apply the 4 valuation methodologies to come up with values and compare them to current prices, I can make investment decisions based on that. And we'll do the economic engineering or engineering economics, the capital budgeting, we'll do that later on. But I just wanted to present the basic formulas, okay? So the last thing you need to understand is if the yield curve shifts up, the discount rate shifts up, and the values go down. The yield curve shifts down, the values go up. If the growth rates go up, the values go up. If the growth rates go down, the values go down. So you got to play with the variables. If the multiple goes up, the values go up. If the multiples go down, the values go down. If the discount rate goes up, the present values go up. If the discount rates go down, the present value, oh, sorry about that. Sorry about that. Sorry, I'm losing it. If the discount rate goes up, the present value goes down, and if the discount rates go down, the present values go up. So if you can learn that, you take away basically the fundamentals. So I think I answered everything on the exam except for that, and we can save that for the next one. Okay. If you have any questions or anything, you can text me, email me, call me, whatever to clarify. And I'll try to get the presentation uploaded as soon as possible. And then what we'll probably do in the